Today, we're going to look at the company Hackett Group, headquartered in the United States and traded on the NASDAQ under the ticker HCKT. Please stay tuned for the important disclosure information at the conclusion of this video. The story of the Hackett Group is a classic example of a specialized firm evolving through strategic consolidation to become a global leader in benchmarking and advisory. While its modern corporate identity took shape in the late 1990s, the company's roots trace back to 1991, when the original Hackett Group was founded to provide data-driven benchmarking for corporate functions. In 1997, a group of former KPMG partners led by Ted Fernandez founded a consultancy called AnswerThink with the vision of bridging the gap between traditional management consulting and the burgeoning digital economy. AnswerThink quickly moved to establish itself in the public markets, launching its initial public offering on the NASDAQ in May 1998. Shortly thereafter, in a move that would ultimately define the company's future, AnswerThink acquired the original Hackett Group. For the next decade, the firm operated as AnswerThink, but as the Hackett name became synonymous with world-class performance metrics and best practices, the company decided to fully lean into that reputation. In 2008, the corporation officially rebranded as the Hackett Group, streamlining its identity to match its most prestigious brand. Throughout its history, the firm has remained resilient by adapting to technological shifts. It survived the dot-com bubble of the early 2000s and later transitioned from a pure consulting model to one that integrates intellectual property and software as a service, SaaS, platforms. Today, the Miami-based firm is navigating the next major frontier by integrating generative AI into its benchmarking tools, ensuring its 30-year legacy of data-driven insights remains relevant in an automated world. The Hackett Group operates as a leading strategic advisory and technology consulting firm, fundamentally centering its business model on a proprietary intellectual property library of best practices and benchmarking data. By 2026, the company has increasingly integrated generative AI and agentic workflows into its core offerings, helping large-scale enterprises automate complex tasks and realize significant productivity gains. Its revenue streams are primarily divided into three functional areas: global strategy and business transformation, which focuses on operational excellence in finance, HR, and procurement; business applications, which handles the implementation of enterprise software like Oracle and SAP; and an executive advisory platform that provides ongoing, subscription-based access to its vast research database. The firm's customer base predominantly consists of Global 1000 and Fortune 500 companies. These clients span diverse industries including automotive, banking, pharmaceuticals, and consumer goods, typically seeking to bridge the gap between their current performance and digital world-class standards. While the United States remains its largest market, accounting for a significant majority of annual revenue, the Hackett Group maintains a robust international presence with offices and delivery centers across Europe, notably the UK, Germany, and Switzerland, Asia-Pacific, including India and Australia, and Latin America. This global footprint allows the firm to support multinational clients in harmonizing their shared services and global business services across different regulatory and economic environments. Over the past 2 decades, the Hackett Group has transformed from a traditional benchmarking firm into a global leader in intellectual property-based strategic consulting and digital transformation. The company's revenue architecture is primarily built around 3 core pillars: global strategy and business transformation, Oracle Solutions, and SAP Solutions. The global strategy and business transformation segment remains the crown jewel, consistently generating the majority of the firm's income by providing world-class benchmarking, executive advisory, and strategic business consulting. The journey through the 2000s and 2010s saw the company weather significant economic shifts, including the 2008 financial crisis, which caused a notable dip in revenue as clients scaled back discretionary spending. However, the firm rebounded by aggressively expanding its ERP solution practices, specifically through its dedicated Oracle and SAP segments, which help organizations implement and optimize enterprise software. By the mid-2010s, Hackett had solidified its reputation for digital world-class performance metrics, a proprietary standard used to measure corporate efficiency. In recent years, the strategy has shifted heavily toward generative AI and cloud-based modernization. The 2024 fiscal year marked a pivotal turn with the launch of the AI XBLR platform and the strategic acquisition of Leeway Hertz, a specialist in AI implementation. These moves were designed to capture the burgeoning demand for AI-driven automation, even as traditional segments like Oracle and SAP face temporary headwinds due to project completions and cyclical transitions. Entering 2025, Hackett continues to refine its revenue streams by integrating AI-led advisory across all service lines. While total annual revenue has stabilized around the $300 million to $315 million range, the mix is increasingly dominated by high-margin intellectual property and digital transformation services rather than pure labor-based consulting. This evolution reflects a broader industry trend where data-driven insights and automated solutions provide the primary engines for growth in a volatile global economy. Understanding the financial narrative of the Hackett Group requires looking beyond the raw top-line figures to the machinery of their cash generation. Over the last 2 decades, the company has transitioned from a mid-sized consultancy into a globally recognized leader in enterprise transformation and Gen AI strategy. This evolution is visible in the table's progression, where revenue grew from $180.6 million in 2006 to over $300 million today. The most striking aspect of their model is the relative stability of their cost of goods sold, which in a professional services context primarily represents the salaries and reimbursable expenses of their consulting staff. As a high-touch services business, their COGS typically consumes 60% to 65% of revenue, leaving a gross margin that must then support the corporate infrastructure and sales engine. Working capital management has remained a point of strategic focus for the company. Professional services firms often struggle with days sales outstanding, where the delay between performing work and receiving payment can choke liquidity. However, the company has maintained a relatively tight window, with working capital changes rarely causing massive swings in their annual cash position. The contract liabilities line is particularly telling. It tracks the cash collected up front for subscriptions or multi-year transformation projects. While these amounts are small compared to total revenue, they represent a float of interest-free capital that the company uses to fund its daily operations before the revenue is officially recognized. A critical metric for any investor or analyst is the final line: free cash flow minus stock-based compensation. This provides a clean look at the cash available to shareholders after accounting for the dilutive effect of paying employees in equity. For the company, this figure has remained robust, often tracking closely with their stated goals of returning value through dividends and share repurchases. Despite the capital-intensive appearance of modern consulting, requiring constant investment in proprietary benchmarks and IP, their capital expenditures remains remarkably low, usually hovering between $1 million and $3 million. This confirms the group as a capital-light business that generates significant cash for every dollar of physical asset it owns. The recent push into generative AI and digital world-class benchmarking is expected to further optimize these margins. By automating the data collection process for their clients, HCKT aims to reduce the general and administrative burden while increasing the value add of their consultants. As we look at the 2025 projections, the stability of their operating cash flow suggests a firm that has mastered the art of eating its own cooking, applying the same efficiency principles they sell to clients to their own balance sheet. This 20-year look back reveals a company that, while sensitive to broader economic cycles like the 2009 downturn, has built a resilient cash flow engine capable of sustaining growth and rewarding long-term holders through disciplined expense management. The financial architecture of the Hackett Group reflects a mature, cash-generative consulting business that prioritizes the efficient return of capital to its owners. Over the last 20 years, the primary engine driving this machine has been its free cash flow after deducting stock-based compensation. This metric is the most honest representation of owners' earnings, as it accounts for the dilutive cost of the equity used to retain high-level talent. Since 2006, this figure has grown nearly fourfold, peaking during the 2022 digital transformation surge. The company's ability to maintain a consistently positive free cash flow after deducting stock-based compensation, even during the global financial crisis and the 2020 pandemic, underscores a resilient, capital-light business model that requires very little physical reinvestment to sustain operations. A defining shift in the company's capital allocation occurred in 2012 when Hackett initiated its first dividend payment. Since then, the dividend has evolved from a modest annual distribution into a reliable quarterly payout, showing steady growth that has roughly tripled in scale over the last decade. Unlike many consulting firms that hoard cash, Hackett has demonstrated a clear preference for returning it. This shareholder-first mentality is further evidenced by their aggressive stock repurchase program. Buybacks have historically been the preferred tool for capital return, often exceeding the total dividend outlay. The massive $58 million buyback in 2022 and the projected $40 million tender offer in 2025 serve a dual purpose. They offset the dilution from employee stock grants and opportunistically retire shares when management believes the market is undervaluing the firm's Gen AI and benchmarking intellectual property. While dividends and buybacks are the bedrock, the firm periodically pivots toward strategic acquisitions to bolster its technical capabilities. These outlays are lumpy but targeted. For instance, the significant spend in 2015 and 2018 represents the acquisition of specialized cloud and technology transformation practices that pave the way for their current focus on digital world-class performance metrics. Most recently, the company is focused on tack-on acquisitions related to generative AI, integrating these capabilities directly into their existing benchmarking platforms rather than pursuing massive, risky mergers that could destabilize the balance sheet. This disciplined approach to M&A allows them to stay at the cutting edge of consulting without over-leveraging the firm. Maintaining this balance requires a surgical approach to the balance sheet. For much of the early 2010s, the Hackett Group operated with effectively zero debt, relying entirely on internal cash generation. However, in recent years, they have more actively utilized a credit facility to manage the timing of large share repurchases. The current total debt of approximately $18 million is comfortably offset by their operational cash flow, keeping their interest coverage ratios exceptionally high. Their cash position typically hovers between $15 million and $30 million, a range that provides sufficient liquidity for daily payroll and expenses while ensuring that excess lazy cash is not sitting on the books when it could be better deployed as a dividend or a buyback. The overall narrative revealed by this 20-year history is one of professional services excellence. By converting intellectual capital into a steady stream of free cash, Hackett has built a fortress-like balance sheet that supports growth and income. For the presenter, the key takeaway is that HCKT is not just a consulting firm. It is a cash flow compounding machine that has successfully navigated 2 decades of technological upheaval while consistently rewarding those who hold its shares. As they move deeper into AI-driven advisory, the core capital allocation philosophy remains the same. Generate high-margin cash, invest modestly in the next wave of tech, and return everything else to the shareholders. The Hackett Group is led by its co-founder, Ted Fernandez, who has served as the company's chairman and chief executive officer since its inception in 1997. Fernandez, who is 68 years old, brings extensive experience to the role, having spent 18 years at KPMG prior to founding the firm. His leadership has recently been focused on a major strategic pivot toward generative AI, highlighted by the 2024 acquisition of Leeway Hertz. For the 2024 fiscal year, Fernandez's compensation structure was heavily weighted toward long-term equity to align with shareholder interests. He received a base salary of $900,000, while his total compensation reached $16 million. The company's ownership structure is dominated by institutional investors, who hold approximately 79% of the outstanding shares as of mid-2025. Individual insiders own about 9% of the company, with Fernandez himself being a key shareholder. Notably, co-founder Paul Jovovich is cited as the largest individual shareholder, possessing roughly 36.95% of the company in some reporting periods. The remaining 12% of the company is publicly owned by retail and other investors. Unfortunately, the liquidation value of the company is negative. Let's build a scenario-based dividend discount model. The bull case for the Hackett Group is a story of total technological dominance, where their digital world-class benchmarking data becomes the global standard for AI-driven enterprise efficiency. In this scenario, the 2024 acquisition of Leeway Hertz acts as a catalyst that transforms Hackett from a consulting firm into a platform-led powerhouse. Revenue growth outpaces the industry as over 50% of new engagements revolve around Gen AI implementation, driving operating margins to record highs of 19%. The primary catalysts here are the rapid adoption of their AI, XBLR, and Z-Brain platforms, which allow for high-margin, software-like recurring revenue. Cash flow becomes so abundant that the firm can fund a 12% annual dividend growth, while simultaneously conducting massive share buybacks. The base case assumes a more measured but steady evolution, where Hackett maintains its market share in a competitive consulting landscape. Revenue grows at a respectable 4% CAGR, slightly above the current 2.6% expectations as they successfully transition their legacy ERP clients, specifically in Oracle and SAP segments, to AI-integrated solutions. In this scenario, operating cash flow margins remain stable at 14%, roughly in line with historical averages. The company continues its disciplined capital allocation, using approximately $200 million for surgical, bolt-on acquisitions to keep its tech stack current. Stock-based compensation grows at 6% as they compete for top-tier talent, but this is offset by consistent shareholder returns. The bear case is a narrative of stagnation where Gen AI becomes a commodity and Hackett's benchmarking data loses its moat. If larger competitors like Accenture or McKinsey develop similar proprietary datasets, Hackett may see its revenue growth stall at no growth. In this case, margins are squeezed to 10% due to pricing pressure and the cost of retaining talent, reflected in a 3% CAGR for stock-based compensation. CapEx remains low, but only because the firm lacks high ROI projects to invest in. Dividends would likely slow to a crawl, and the share repurchase program could be suspended to preserve the cash flow. In the bull case scenario, we assume the following: revenue growth at 12%, operating cash flow margin at 19%, CapEx growth at 8%, stock-based comp growth at 10%, dividends growth at 12%, stock repurchase at 10%, acquisition spending in the next 20 years at $500 million. Stock repurchases assumes price-to-sales ratio of 1.5. With this discounted at 7.5%, dividend model yields $39 worth of value per share in 20 years, $116 in 30 years, and $303 in 40 years. In the base case scenario, we assume the following: revenue growth at 4%, operating cash flow margin at 14%, CapEx growth at 5%, stock-based comp growth at 6%, dividends growth at 1.5%, stock repurchase growth at 0.5% after a significant cut, acquisition spending in the next 20 years at $200 million. Stock repurchases assumes price-to-sales ratio of 1.5. With this discounted at 7.5%, dividend model yields $8 worth of value per share in 20 years, $11 in 30 years, and $13 in 40 years. In the bear case scenario, we assume the following: revenue stalls with 0% growth, operating cash flow margin at 10%, CapEx growth at 2%, stock-based comp growth at 3%. After significant cuts, dividends continue to grow at 1%, stock repurchase are canceled, acquisition spending in the next 20 years at $50 million. Stock repurchases assumes price-to-sales ratio of 1.5. With this discounted at 7.5%, dividend model yields $5 worth of value per share in 20 years, $6.30 years, and $7.40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.